China is doubling down on its COVID-0 policies. The Bank of England is going a little more dovish than markets expected. Yet Jerome Powell is doubling down on what appears to be this core mission to get all stocks to lose at least 50% of their value. As we saw in videos I made yesterday, Jerome Powell seems really frustrated at the thought that stocks could potentially rally or move up, not only because of what we saw during the press conference of Jerome Powell doubling down on talking the market down as soon as there were any kind of potential thoughts that the market might actually be going up, but it's literally what we were told by Nikki Leaks in the Wall Street Journal, where the biggest risk to financial conditions for the Federal Reserve is a loosening of tight financial conditions, which we would see a loosening of tight financial conditions if we saw Treasury yields fall and a sustained market rally undoing the Federal Reserve's work. So in other words, there's this direct correlation between markets going up and the Federal Reserve feeling like their work is being undone. So, does the Fed actually have any freaking clue as to what it's doing? Because after all, we have to say, it's very weird that this morning, the Bank of England came out with their highest rate in 33 years, highest rate increase in 33 years. They came out with a 75 basis point hike. But what was fascinating about the 75 basis point hike is they combined that with actually a dovish message. They combined that by saying that terminal rates, that is peak interest rates at the Bank of England, will actually likely be lower than what the market is expecting. We got the exact opposite here in America, which is, hey, we've got a little dovish memo that we're going to take into account all the cumulative lags, but we're going to raise rates more than markets are expecting. And at this point, I just feel convinced that Jerome Powell has absolutely no clue what's going to end up happening with interest rates or quantitative tightening. I think he has no clue. And he said himself that the markets that we're in now are modern economies that have differences in them than what we've seen in the 1970s era inflation or any time before that. And as a result, I think Jerome Powell is basically politely saying, look, it's November. And like Kevin said before the Fed meeting of November, the Federal Reserve can't risk going super dovish right before 2 jobs reports and 2 CPI reports. Let's wait for those reports. Let's wait for those reports to come out. And hey, you know what? If those reports come out and show that joblessness is increasing and that CPI is falling faster than expected, hey, maybe then it's time to take the foot off the brake. Maybe then we can U-turn. In fact, that's what Jerome Powell suggested. He told us yesterday that they would rather over-tighten and start printing money again than under-tighten and risk losing control of inflation. And that tells us bluntly, especially since right after that he said, by the way, we haven't started over-tightening yet. He thinks we've tightened a normal pace, which basically means we can still over-tighten. It's kind of like we're going 60 miles an hour, and he's like, hey, you know, if we hit 80 miles an hour, we could always hit the brakes. By the way, we're not at 80 yet, so let's hit the gas a little bit more on rate hikes and aggressiveness and hawkishness, right? So what do you have is a Federal Reserve that's basically telling you, look, so far we're failing. And as we continue to fail, we're just going to have to get more and more aggressive. And we're going to do whatever we need to do to be correct about how we handle inflation. And if that means reducing the value of your stocks, the value of your home, the value of your home equity, which is at record highs, I'll have a separate video coming out on home equity, what ends up happening? You get a Fed that's more aggressive. And of course, we do have the hope that the next reports are going to be good. But hope isn't really the best investing strategy, or at least I should say, hasn't yet been the best investing strategy. Sure, if the next 2 CPI reports and 2 job reports come in soft, Jerome Powell can not only reduce the pace of hikes to 50 in December, but maybe they'll actually reduce their summary of economic projections. Maybe right now they're saying, hey, today the summary of economic projections would be worse and the terminal rate, instead of being 4.6%, would actually be 5% or 5.5%. But what if those reports come in bullish? And what are the expectations for the jobs report that comes out tomorrow? I have those expectations right here. And in addition to those job expectations, what do we think about CPI expectations going forward into next week? Let's talk about both of those right after our message from our sponsor, Established Titles. You know, some of you might not know, but I'm not a landlord anymore, and I'm a little disappointed about this because, I sold 85% of my properties, all the ones with tenants in it, and I'm not a landlord anymore. So now when people are like, but hey, Kevin, the New York Times has you featured as a landlord influencer, but you're not actually a landlord, like, what happened? I thought you were the landlord to go to with questions about landlording online. And I have to say, I was so disappointed. I thought, you know what? Maybe there's a way I can become a landlord again. And so what we did is we got ourselves 1 square foot of land in Scotland. And now we're technically lords of the land again. We have 1 square foot of dedicated land on a private estate in Scotland. We have an official certificate to go with it. And I'll show you that certificate, and I'm gonna take you into this special spot where my certificate is. See, my certificate features a unique plot number, so that way I can always geolocate my exact location. And the company that plots these plots and sells these plots plants a tree with every single order. So if you want to be a landlord, consider using the link down below, and you can officially change your name to Lord or Lady, like on your plane tickets and credit cards. There's some things you can't put it on, like passports and driver's license, sadly, but I'm officially a lord again. So you can now go to establishedtitles.com/meetkevin to get your last minute gift for someone else. You get 10% off when you use the Meet Kevin coupon code, or you go to establishedtitles.com/meetkevin. What's really cool is Established Titles is running a large sale right now that's unique to this moment in time. So make sure you use that code MEETKEVIN to take advantage of that sale. And quite frankly, it's kind of cool to officially say I'm a landlord again. By the way, Established Titles told me the first 200 people purchasing a title pack using my link down below will effectively be next to my plot within a few minutes of walking. Depending on how many of you want to become a lord or lady, we can build our own little channel named Kingdom 93. Show you the certificate. Here it is, my certificate in my new podcast set. Don't tell anyone yet, but we are gonna hang this up so that way I'm officially a landlord in my podcast set. Let's go. Okay, so expectations, and could we potentially beat these expectations, which would lead to an actually dovish Fed rather than this aggressive Fed that just says stocks should go down? Well, regarding jobs, we are expecting tomorrow the jobs report to come out at 5:30 a.m. And when it comes out at 5:30 a.m. California time, we're expecting a change in payrolls of 200,000. That means a gain of 200,000 jobs. We expect most of those to be in leisure and hospitality, as we saw in the ADP private payrolls report yesterday. That is a slowdown from the 263,000 jobs that we gained the last time, and it would potentially tick the unemployment rate up to 3.6%, while keeping average hourly earnings stable at 0.3% and reducing the average hourly earnings year over year to 4.7%, with labor force participation also staying stable at 62.3%. Those are the expectations for the jobs market. That actually doesn't show you any kind of meaningful slowdown yet, but if we tomorrow get a jobs report that comes in weak, and we get one that suggests, hey, we only added 50,000 jobs or 100,000 jobs, way less than the expectation, or we're getting anything close to zero. Wow, we went a month without actually on net adding jobs, because you've got people like Elon Musk now threatening to lay off 50% of Twitter staff, which would be somewhere around 3,750 employees. Hey, that's fewer jobs created, right? And if all of a sudden you get on the balance of having more negatives in a month, then that actually shows that the Fed is potentially going in the right direction and will much more likely be reducing wage inflation, especially since people are unlikely to quit their jobs to go to an uncertain path of a job market that might not actually be hiring in a recession. So there's jobs. Then on the 10th, which is a week from today, it's Thursday, at 5:30 a.m., we're going to get the inflation report. And now I have to tell you, I'm actually kind of excited about these estimates, because there's one thing I want to tell you about estimates. is that they're almost always wrong. The problem is, when the estimates come in really, really low, it's hard to show a beat because markets are already expecting that inflation read to come in low. So for example, when markets are like, oh, we expect inflation to be 0.2% month over month, it's like, that's already pretty dang low. Like, how are we going to do better than that expectation, right? Well, listen to this expectation. The expectation for CPI month over month is 0.7%. That's an 8.4% annualized pace. I'm actually optimistic we can beat that. Not only that, but core CPI numbers are expected to come in at 0.5%. That excludes food and energy. This is going to be lifted up by housing, but if we could get larger declines in other sectors, we could actually anchor down that services-based inflation from housing. That expectation is 0.5%. It's also not great. It's a 6% annualized rate. And we see the CPI year-over-year figure coming down only from 8.2% to 8.1%, which actually isn't a really bullish CPI estimate. In my opinion, it's actually a pretty bad CPI estimate. But I think it's one that we could meaningfully beat to the low side, which could be really good. And so here's the fact. Here's the bottom line about whether markets are going to go down another 50% or not. And you have to place your bets on what you think. For the next 2 jobs reports and the next 2 CPI reports, do you think those reports are going to show that we're starting to lose momentum in the jobs market, that things are slowing down at companies, that we're seeing layoffs, not just at Twitter, but Open Door laying off 18% of their staff and more, that we're seeing these slowdowns, and that CPI is actually in the next 2 reports going to come in lower than expected, and CPI is going to fall quicker than expected? If you believe that for the next 2 reports between now and the December meeting, we could actually end up having a Jerome Powell that in December says, look, we're going to go 50, but we might actually be good. We get really good reports, these next 4 reports, 2 jobs, 2 CPI reports. We might get a Fed that literally tells us, you know what? We actually might drop to 25 in January and just stay stable and hold by March. That would probably lead to some substantial bullishness. Now, I know that the Federal Reserve, because I started with it, is worried about causing a stock market rally. But I don't think the Fed cares if the stock market rallies as long as the reports are coming in good. If the stock market rallies and the reports are coming in bad, he's going to talk the stock market down. And this is where you have to ask yourself, if you think inflation is going to get worse and you think that labor market's going to remain strong going into December with these next 4 reports, then you probably want to be shorting this market. You probably don't want to be long stocks because there's not actually going to be a dovish Fed. You can only get a real dovish Fed when these reports come in positive. Now, I think the expectations are such that we set ourselves up for positivity, especially with what's going on. Look at some of the industries, okay? Residential investment slowing at companies like Generac. Even though you've got beats at companies like Enphase and Sunrun recently, we are starting to see some signs of slowing and cracking in household spending. Business fixed investment starting to decline. We're seeing layoffs and hiring freezes across the board, not just at tech companies, but at manufacturers, at autos companies. But also, take a look at this report from Fast Company. 85% of small businesses say they plan to implement hiring freezes during the economic downturn. 78% of small businesses plan to lay off employees. 87% of small businesses have to re-examine fixed costs like leases and insurance benefits and potentially ask for discounts. The Jamba Juice I worked at as a kid just went out of business. Crazy. 43% of small business owners are planning to use freelancers to fill the gap. Here's a Barron's article. Hiring is slowing and the downsizing events are beginning to occur. Retailers so far cutting 11% of their workforce. Amazon not increasing the number of seasonal hires it's looking for this seasonal sector. Layoffs in the tech sector jumped 86% for the first 9 months of the year compared with the same period last year. Walmart is cutting 200 corporate jobs. GE cutting 20% of its U.S. workforce. Bed Bath & Beyond, well, I mean, they're going to go bankrupt here, reducing its workforce by about 20%. Wayfair, 5%. Peloton, another 600 job cuts. Obviously, tech, but even in financial services, Goldman Sachs down 1 to 5%. Advertising companies like Google and Snap planning layoffs. So you're seeing the inflection points. It just unfortunately is going to take a while to see these actually come to fruition. Hopefully they come through within the next 4 reports here before the December meeting, but things might just take longer. I do believe wholeheartedly, though, because quite frankly, J-Pow doesn't really know the impact of the tools he's using, he's just going to be really aggressive until he doesn't have to be really aggressive anymore. So if we actually start seeing some of these cracks show up in the data, which unfortunately lags and we have to have a lot of patience for to see, then we don't have to paper hand, we don't have to capitulate, and we can hold through what could be another 2-3 months of pain, and hopefully we see some light at the end of the tunnel then. And I really believe that once we see that light at the end of the tunnel and we see that Fed policy is working, we're not going to be dragging the anchor along the bottom of the market anymore, which right now we're a teeny tiny little bit above that bottom, but I do think we're going to be bouncing around and range bound until we actually have good news on those reports. I think it's coming. It's just more hurry up and wait.